The biggest mistake new investors make is letting emotions, not a plan, drive their decisions. Markets reward patience and discipline, yet the first experience many beginners have is a roller coaster of excitement when prices rise and fear when they fall. Those feelings are human, but investing punishes emotional reactions. The typical pattern is familiar: buy what just went up, panic when it goes down, and repeat. Over time, this cycle quietly transfers wealth from the impatient to the disciplined. Performance chasing is the most visible expression of emotional investing. After a strong run in a stock, sector, or cryptocurrency, headlines and social proof create a sense of inevitability. New investors extrapolate recent returns into the future and buy near peaks. When momentum fades, as it always does, loss aversion takes over. The fear of further loss feels worse than the possibility of future gain, so they sell into weakness. The result is buying high and selling low, a formula that would ruin even the best asset. A second related error is neglecting diversification. Concentrated bets are thrilling because they offer a clear narrative and the possibility of outsized gains, but concentration substitutes story for statistics. Diversification is not about eliminating risk, it is about avoiding a single point of failure. New investors often learn too late that even good companies can suffer bad outcomes, and that a portfolio built on one theme has the fragility of a one legged stool. Short termism compounds these problems. Beginners frequently measure success in days and weeks, not years and decades. They check prices constantly, mistake volatility for danger, and confuse activity with progress. The market is a device for transferring money from the active to the patient. Trading costs, taxes, and the opportunity cost of being out of the market add up. Compounding works only for those who give it time. Underneath these behaviors lies a mismatch between investments and the investor's true risk tolerance. It is easy to declare oneself aggressive in a rising market. It is much harder to remain aggressive when portfolios fall 20, 30%. When the portfolio's volatility exceeds the investor's emotional bandwidth, the plan breaks at the worst possible moment. Risk tolerance is not what we believe in calm times, it is what we can endure in storms. All of these mistakes trace back to the absence of a written plan. Without one, every market move is a referendum on what to do next, and the loudest voice is usually fear or greed. A simple plan is not complicated. Define the goal, what the money is for, and when it will be needed. Choose an appropriate asset mix, automate contributions, and set rules for rebalancing. With those elements in place, especially rebalancing, investors systematically sell some of what has done well and buy what is out of favor, the opposite of performance chasing. The antidote to emotional investing is process. Build an emergency fund so market declines do not threaten daily life. Use dollar cost averaging to neutralize the temptation to time entries. Diversify broadly across asset classes and geographies to mute the impact of any single mistake. Rebalance on a schedule or when allocations drift beyond preset bands, turning volatility into a discipline rather than a danger. Most importantly, write an investment policy statement for yourself, a one-page document that states your objective, target allocation, contribution plan, and the exact conditions that would justify a change. When markets are loud, let that quiet page decide. New investors do not fail for lack of intelligence or information. They stumble because markets test temperament more than they reward brilliance. The market will always offer reasons to act now: headlines, predictions, and sharp price moves. The investor's edge is the willingness to act slowly, according to plan. In the end, the greatest mistake is emotional investing. The enduring success belongs to those who replace impulses with rules, stories with statistics, and noise with a written, repeatable process.